Ever heard the term Topside Journal Entry and wondered what it really means in accounting? In this video, we'll break it down with a real example and you'll finally understand why these entries never touch a subsidiary's books. Let's dive in. A topside journal entry is an adjustment made at the corporate or consolidation level, not in the books of individual subsidiaries. These entries are used to fix or adjust consolidated financial statements, not individual company records. Think of it as a final polish, ensuring that group-level reports reflect the full financial picture, including executive bonuses, intercompany eliminations, or corporate-level adjustments. So, why not just record these in the subsidiaries' ledgers? Because topside entries often don't apply to any one subsidiary, they relate to the group as a whole. Also, subsidiaries need clean books for local tax reporting, audits, and performance tracking. Imagine subsidiary A getting hit with a corporate stock-based comp expense. It's not their call. Instead, the consolidation team handles it from the top. Here's a quick example. Let's say the corporate office wants to book a $1 million executive bonus. No subsidiary is responsible for this, so we book a topside entry. Debit. Compensation expense $1 million. Credit. Accrued liabilities $1 million. This entry doesn't go into any subsidiary ledger, it's recorded only in the consolidation system to reflect the true cost at the group level. To wrap up, topside entries are made at the corporate level. They adjust consolidated reports. They don't appear in subsidiary ledgers. They're crucial for clean, accurate group financials. Now you know what a topside journal entry is, and why it matters. If you found this helpful, give it a like and check out our video on intercompany transactions next.